Conversations between shareholders and accountant. Shareholder 1, good morning. As we approach the year-end, could you give us an overview of the tax strategies we should consider to optimize our position? Accountant, good morning. At year-end, we focus on strategies such as deferring taxable income. For example, we can postpone revenue recognition or accelerate deductible expenses like repairs and maintenance. Additionally, we should review capital expenditures to take advantage of accelerated depreciation or bonus depreciation, if applicable. Shareholder 2. Are there any changes in tax laws that we need to be aware of when preparing our year-end returns? Accountant. Yes, tax laws are constantly evolving. We need to keep an eye on changes to corporate tax rates, deductions, and credits. Additionally, if there are updates regarding the treatment of foreign income or withholding taxes, those could impact our international subsidiaries. I'll ensure our tax filings reflect these changes. Shareholder 1. Should we adjust our provisions for income tax in light of an upcoming audit? Accountant. It's essential to review our current tax provision to ensure it aligns with our actual tax liability. If there are estimates made during the year, we'll need to adjust them based on the final income statement. Properly adjusting provisions helps avoid discrepancies during an audit. Shareholder 2. Let's talk about our capital structure. How does it impact our taxes, especially regarding interest deductions? Accountant. Interest on debt is generally tax deductible, which lowers our taxable income. However, it's important that we comply with thin capitalization rules, which limit the amount of interest deduction based on our debt-to-equity ratio. If we take on too much debt, the tax authorities could limit our interest deductions. Shareholder 1. Is there a cap on how much debt we can use for these deductions? Accountant. Yes, there are limitations depending on the jurisdiction. For example, some countries may restrict interest deductions if our debt exceeds a certain percentage of equity. We need to ensure our debt levels remain within acceptable limits to avoid losing these deductions. Shareholder 2. So, would it be better to reduce our debt or increase equity to optimize tax deductions? Accountant. That depends on our overall strategy. If we increase equity, we may reduce interest deductions but also lower financial risk. More debt could give us larger deductions up front, but it increases our exposure to interest rate fluctuations. It's a balancing act between tax efficiency and financial stability. Shareholder 1. Moving on to dividends. How do they affect our taxes? Should we distribute more or retain earnings this year? Accountant. Dividends are subject to withholding taxes. If we distribute them, there will be tax implications both for the company and shareholders. On the other hand, retained earnings don't trigger immediate tax expenses but limit the funds available to shareholders. We should consider the tax rate on dividends in our jurisdiction before deciding. Shareholder 2. Is it more advantageous from a tax perspective to retain earnings rather than pay dividends? Accountant. Retaining earnings can help us reinvest in the business without triggering immediate tax costs. On the other hand, paying dividends could be beneficial for shareholders who are looking for income, but it will result in a tax liability for both the company and the shareholders. Shareholder 1. Should we pay dividends now or defer them to the next tax year? Accountant. If we defer dividends, we might avoid taxes this year, especially if we expect a lower tax rate next year. However, we also need to consider our shareholders' preferences and the company's liquidity. Shareholder 1. Can you explain how VAT is handled, particularly with our sales and purchases? Accountant. VAT is a consumption tax collected from customers on sales, which we remit to the government. On purchases, we pay VAT to suppliers and can deduct this input tax from the VAT we owe on sales. The difference is what we pay to the tax authorities. Shareholder 2. How do we manage VAT compliance across different regions, especially with international sales? Accountant. VAT rules vary by country. If we sell internationally, we must be aware of each jurisdiction's tax rates and requirements. In some cases, we may need to register for VAT in different countries, depending on our sales volume. We can also reclaim VAT on exports in certain jurisdictions. Shareholder 1. Is VAT treated the same way for services as it is for goods? Accountant. Generally, VAT on services is treated similarly to VAT on goods, though there are exceptions depending on the type of service and where it's provided. Some services may not be subject to VAT in certain jurisdictions, so we must review the specific rules for each service we offer. Shareholder 2. What about stock options? How are they taxed and accounted for? Accountant. Stock options are a form of compensation. The tax treatment depends on whether they are incentive stock options, ISOs, or non-qualified stock options, NSOs. SOs can qualify for favorable tax treatment, whereas NSOs are taxed as ordinary income when exercised. Shareholder 1. What about the accounting for stock options? How do we recognize them on the financial statements? Accountant. Stock options are recognized as an expense on the income statement based on their fair value at the grant date. This is amortized over the vesting period. We calculate the fair value using pricing models like Black-Scholes, which factors in the stock price, exercise price, volatility, and other factors. Shareholder 2. Are there any tax deductions available related to stock options? Accountant. Yes, we can claim a tax deduction equal to the amount of income recognized by the employee when they exercise the options. This deduction is recognized in the year the employee exercises the options. Shareholder 1. We've made significant capital investments this year. How will depreciation affect our tax position? Accountant. Depreciation allows us to spread the cost of an asset over its useful life, reducing our taxable income each year. The method of depreciation we choose will affect how quickly we can take those deductions. For example, straight-line depreciation spreads deductions evenly, while accelerated methods provide larger deductions in the early years. Shareholder 2. Which depreciation method is better for reducing our current tax burden? Accountant. If reducing taxes is a priority, accelerated depreciation methods like double declining balance will give us larger deductions in the first few years. This reduces taxable income early on, although it also means smaller deductions in later years. Shareholder 1. Are there any additional tax benefits related to depreciation? Accountant. Some jurisdictions offer bonus depreciation, which allows us to deduct a larger portion of an asset's cost up front. This can be particularly beneficial for new assets and can significantly reduce our taxable income in the first year.